Mortgage rates just jumped again, and normally that spells absolute disaster for buyers, right? It usually drains whatever tiny bit of power they have left. But something really strange is taking shape instead. Because for the first time in years, those same buyers might actually be getting their leverage back. And honestly, if that's true, the story unfolding right now is way bigger than just rising rates.
You know, for years, literally everyone has been asking the exact same question. When are rates finally going back down? But suddenly, reality hit. Rates just shot up to 6.56% in a matter of weeks, which instantly chilled the market. But here's the crazy part. Instead of triggering total chaos, it's causing something we haven't seen in a very long time: unexpected flexibility from sellers. It's like the market isn't waiting for a drop anymore. It's just adjusting to the very real possibility that rates might stay exactly right here.
So here's where this gets really fascinating. Because mortgage rates didn't just jump because of housing itself. No, the chain reaction actually started somewhere else entirely. Think back to late February. An overseas conflict escalated, pushing oil past $108 a barrel, which completely reignited inflation anxieties. And that made investors super nervous about global sovereign debt, triggering this massive bond market sell-off. It's literally the perfect example of how global anxiety can travel all the way across the world and land right on your kitchen table in the form of a higher monthly housing payment. And the direct link between that global anxiety and your wallet, it's 4.7%. That's the yield the 10-year Treasury note just hit, which is a 16-month high, by the way. Now, why does this actually matter to us? Well, because mortgage lenders tether home loans directly to this note. When investors panic and start selling off bonds, this yield spikes. And your mortgage pricing, yeah, it gets dragged aggressively higher right along with it. But here's the thing. This sudden rate shock, it isn't hitting everyone equally, not even close. While the baseline 30-year conforming rate sits at 6.56%, jumbo loans are feeling an even tighter squeeze. But the real, absolute strain is happening with FHA loans, sitting at 6.26%. You know, these are the government-backed programs with flexible underwriting that first-time and lower-income buyers really rely on. So when these rates jump, it places a massive, disproportionate strain on the exact buyers who have the absolute least amount of financial wiggle room.
And people didn't just wait around when these rates moved. The second borrowing costs went up, human behavior changed instantly. Standard purchase applications just dropped off a cliff, but applications for adjustable rate mortgages, ARMs, suddenly jumped to nearly 10% of total volume. That's the highest level we've seen since October 2025. Buyers are essentially scrambling for immediate survival here, looking for absolutely any way to make the monthly math work.
And let's look at exactly why they're doing it. It comes down to an 80 basis point spread. The average 5/1 ARM is sitting at 5.76%, compared to the 6.56% 30-year fixed. To put this into real-world perspective, if you're buying a $700,000 home in Washington, D.C. right now, choosing the ARM saves you roughly $375 every single month. I mean, when affordability is stretched this incredibly thin, $375 is literally the difference between getting the keys and having to walk away entirely.
But of course, that creates a massive hidden tension. Because while an IRM totally solves the affordability problem today, it introduces a severe systemic risk for tomorrow. The rate on a 5/1 ARM is only fixed for 5 years. If global pressures remain and mortgage rates don't retreat, today's little affordability fix becomes a huge financial stress test in 2031, right when these loans reset to whatever the prevailing market rate happens to be. It's super easy to ignore future problems when you're just struggling to survive today's costs, right? Now, as all of this is unfolding on the ground, a massive wild card enters the picture at the macroeconomic level. The Federal Reserve is undergoing a huge leadership transition, with Kevin Warsh stepping in as chair, and he's walking into a market that has entirely priced out any interest rate cuts for 2026. The real interest rate is suddenly right at the center of a very delicate policy dilemma, balancing incredibly stubborn inflation against heavy, heavy political pressure to bring costs down. Let's actually walk through the math on this really quickly, because it's absolutely crucial to understand. If you take the nominal federal funds rate of 3.63% and then subtract the PCE inflation reading of 3.5%, you get a real interest rate of just 0.13%. Okay, so what does this actually mean? It means we are seeing passive monetary loosening. The Fed hasn't cut rates at all, but because of how inflation is acting, conditions have practically loosened by over 50 basis points. Meaning, the Fed might actually need to tighten further just to keep fighting inflation. Crazy, right? To navigate this, Warsh is pushing a highly debated framework. He's arguing that an artificial intelligence productivity boom is going to make the economy so efficient that it acts as a massive disinflationary force, which theoretically would allow the Fed to cut rates. But a lot of mainstream economists, they're incredibly skeptical. They see this as a highly optimistic forecast, pointing out that AI productivity gains are likely going to take much longer to actually arrive. So right now, experts aren't just disagreeing about interest rates, they're entirely divided on the future trajectory of the whole economy.
But hey, while the economists debate AI and macro policy, let's snap back to the immediate reality of the everyday renter trying to enter this market right now. $2,605. Take a second to think about that. That is the median liquid assets held by a renter today. This exposes the extreme wealth constraints of today's buyer pool. We're talking about people hitting an absolute impenetrable financial ceiling.
And because buyers are stretched to that ceiling, we are seeing a dramatic shift play out. The median down payment has plummeted 19% year over year, dropping down to $23,400. That's a 4-year low. Buyers simply don't have the cash reserves they used to, so they're increasingly bypassing conventional financing and flocking to government-backed, low down payment loans like FHA and VA programs. Honestly, just to get a foot in the door.
Which finally brings us to the payoff of this entire paradox. Because buyers have hit their absolute financial limit, sellers are suddenly losing their historical leverage. Nearly 40% of sellers now expect to offer concessions, things like paying for closing costs or offering temporary interest rate buydowns just to close a deal. Think about it. For years, buyers had to waive inspections and rush into brutal bidding wars. Now, they're getting the one thing they haven't had in years: time and the actual power to negotiate. And this shift in leverage has created a really rare, completely surprising market reversal. Get this. Right now, the median newly constructed home is actually selling for less than an older existing home. Like, how is that even possible? Well, it's because massive home builders, backed by deep institutional funding, are using their sheer scale to offer direct price cuts and aggressive mortgage rate buydowns, so everyday homeowners trying to sell their houses are being forced to cut their asking prices just to compete with the new builds down the street. But look, if you think this is happening everywhere equally, we need to completely destroy the idea of a single national housing market. Right now, there are several vastly different markets operating at the exact same time. Just look down south at the Sun Belt. Inventory is surging. Texas prices are down 1.7%. In Dallas, a staggering 70% of properties are closing below asking price. Over half the sellers in Phoenix are slashing prices. If you live in these areas, a firmly buyer-friendly environment is really taking hold. But contrast that with the Midwest and the Northeast. These regions remain incredibly insulated from all of this. Active inventory is still way below pre-pandemic levels, which keeps extreme pressure on buyers and causes prices to keep climbing. In places like Chicago, the affordability gap is so tight that builders are turning to extreme solutions, literally developing neighborhoods of 600-square-foot microhomes just to offer something people can afford. So while one person is seeing aggressive price cuts in Dallas, another is fighting a bidding war for a tiny home in Illinois. So what exactly comes next for us? Well, major housing authorities project that average 30-year rates are going to remain elevated, likely hovering between 6.20 and 6.60% right through the summer. Transaction volumes will probably stay slow but steady. We definitely aren't going back to the hyper-competitive 3% rate era anytime soon. Instead, we're entering a phase of progressive normalization. It's a phase shaped by elevated borrowing costs, highly creative financing, and a slow, steady return of leverage right back to the buyer. The bottom line is, the housing market isn't frozen. It is actively rewriting its own rules in real time, driven by global events, shifting central bank policies, and buyers pushing themselves to the absolute financial brink. The national headlines are only ever telling a fraction of the story, because the real impacts are hyper-local. So if the macro forces out there are completely shifting the balance of power, how will your specific neighborhood adjust when the next ripple hits?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.